Hello there. We are live. It is actually 4:36, running a couple of minutes late, but I'm going to give myself a pass because I've been streaming now, live streaming daily, I think since like March. No, since February. And it's just one of those things. You ever have one of those days, things are scattered all over the place, and I'm really going to have to come in here one night or over the weekend and put it all together. Happy tax day, everybody. Today is July 15th. 2020. Everyone is sending their taxes in a little bit later this year because of the CARES Act and the extension that Congress gave everybody to file their taxes. So today's the day. Hopefully you have already done that, and hopefully you didn't have to pay too much. Maybe you're getting a little refund back. Remember, if you pay too much, you're not paying enough during the year, and if you get a big refund, it means that you loaned the government money and you're paying too much. You want to try to get that out as evenly as possible. I know it's tough. And I know some people look at a refund as somehow as a forced selling. So I'm not knocking you. If it works for you, then it works. Let's do a couple of things today. I'm going to make this very brief. What we need to do is this. Have you been able to stay the course? Because now that basically the stock market, as we look at it as the S&P 500, is basically even on the year. Whether the S&P 500, the Dow Jones, the NASDAQ, the Russell 2000, these are indexes. You can't invest directly into an index, but you could invest in a security that tracks or mimics an index. So now that the major averages are basically flat, the Dow is still off a little bit. NASDAQ is up solidly this year, up about 17, 18% year to date. Now that all is said and done, have you been able to stay the course through the pandemic and the volatility? This year, look, we could talk about a year for the books, but I'm just focusing on the stock market aspect. We had some crazy down days. We had a 3-week market crash where the S&P went down about peak to trough 34%. Not about, it went down 34%. We had days where the stock market slammed shut right on the open because stocks went limit down, meaning when stocks go down a certain amount, the exchanges halt trading. We've had a bunch of those. We had a 2,000 point down day, an 1,800 point down day. We had oil plunge. We even had oil go to negative value very briefly. Yeah, that's right. You actually had to not pay for oil, but somebody else would have paid you a tiny bit for your oil. So it's just been one of those, not one of those. I can't say it's been one of those crazy years because we've never had a year quite like this. But did you stay the course? Did you hold on to your stock positions? Did you make crazy changes in your 401k that you shouldn't have made? Or did you react a little bit and realize, maybe, you had too much money in stocks, and then you quickly reassess that you don't want to take so much risk, and you move some of that money into a bond fund or into a money market or a cash fund. So these are the things we're going to talk about. So let's just do a quick roll of the intro. We're going to get into this. Let me get the right screen here and then we're going to do a quick update. I'll work in the whole show into the update, and I'll have you on your way really quick. Welcome to Be the Boss of Your Money. My name is Mitch Goldberg. I'm a financial advisor with decades of experience. The show is called Be the Boss of Your Money because I want you to be the boss of your money and not your money to be the boss of you. It's very easy to lose control of your money, and I think you need to know how to do a couple of things. You need to know how to invest. You need to know how to stay the course. You need to know if your investments are appropriate for you. So let's just take a quick look. We'll do a share screen, and we're going to follow up from yesterday. If you missed yesterday's episode, don't worry about it. You don't need to have watched that as a prerequisite for today. But you see here the Dow up a little over 200. It's only 0.85% at this point. A good day, we'll take it. S&P up 0.9%. NASDAQ up less, up 0.59%. That's been leading the way. So that has, up a little bit today. Russell 2000 up 3.5%, which is a huge day for any benchmark. And the VIX is down 6%. Typically, the VIX up or down, it's going to be a higher percentage move than the than the major averages. It's a fear gauge. It's staying under 30. That's important. When the VIX goes up, it tells you that investors, large investors, professional traders are actually worried about the market and they're paying money to hedge their positions. All right. So if the VIX goes down, that means there's a little bit more. I'm not going to say complacency because the VIX, almost 28 is not complacency, but people are feeling a little bit more comfortable that we're going to avoid the worst of a COVID-induced shutdown. The reason for that, of course, is if you haven't heard, hopes for a company called Moderna. They have a vaccine and a very small trial of only 45 people. Every single person had a robust response and created COVID-19 antibodies, which is the response that you want, because if your body can create the antibodies to the COVID bodies, so to speak, then that would neutralize the disease and you would you might not even know you had the disease. Okay, so that's a very, very positive development. Let's move on down. So here's the news. Moderna shares jump as much as 16%. They weren't up 16% on the day, but they were up like 8%. But nonetheless, they were down about they were up whatever they were up today, they were down yesterday about the same amount. So it's a nice little recovery on the stock. But more importantly, we've got over 100 companies working on a vaccine. Actually, more than 100 companies, but there are about 100 vaccines in the works. Let's take a look at some of the big movers. Royal Caribbean up 21%, Norwegian Cruise up 20%. So the cruise lines and airlines and some retailers like Gap was up 12%, Carnival was up 16%, United Airlines up 14%, American up 16%. So, today shows you something that we've been talking about. We talk about a letter of the day, like is it a V-shaped recovery, a U-shaped recovery? Today is definitely a V-shaped kind of day. What I had said yesterday was that technically I said yesterday was a very good day for technicals of the market and helped repair some technical damage the day before. So what I mean by that is the worry was that investors were feeling overly negative, maybe. Well, not overly if it's for justified reasons. But the charts were looking really bad. Technology stocks looked like they were rolling over. Yesterday repaired some of that damage, and today continued yesterday's trend. So overall, today was actually a pretty good day, and it was definitely a day that favored economically sensitive stocks, which is why we call it a V-shaped day. Let's go on a little bit more. We're going to take a look at the FANG stocks. FANG, what I've been saying is if we do come out with a vaccine, that might not be so great for the FANG stocks in a perverse way. It could be bad for the FANG stocks and for tech stocks in general. Because it takes away the impetus to own the work from home and the screen stocks. So now money could shift to the reopening stocks, the cyclical stocks like airlines, cruise lines, the industrials. You think of the heavy machinery companies like a Caterpillar, John Deere, that sort of thing. So Facebook was up a touch. Apple was up a tad bit, closing in on that $400 mark. But Amazon was down 2.4%. Netflix was down. Alphabet, which is the symbols Google, is down. Microsoft was down a little bit. So more down than up in the FANG stocks, which is more or less what we expected would happen. And then we take a look at the sectors. Industrials were the leader of the day, energy and financials. I always say industrials, energy, and financials are the most important sectors you need to see leading the way higher, especially financials. That gives you the it tells you that investors are confident about a V-shaped recovery, about a cyclical recovery, and about getting out of this recession. So that is a very bullish sign. It doesn't mean that those will continue and that'll last. I'm just giving you a snapshot of what this day was like. And at the bottom, you had utilities, consumer staples, energy toward the bottom, which is, again, what you would expect in a day like today. So let me just stop sharing the screen. So today was overall a decent day. It was one for the for the V-shaped recovery. If you have any questions, by the way, hit me up in the comments. If you're watching this in the replay, I'd like to welcome you as well. So there are a couple of things that I do to help my clients stick to an investment plan. And by and large, I think most of you watching this have stuck with your investment plan. Some of you are trading or investing in individual stocks on the side as more or less, a different, maybe that's the more aggressive part of your portfolio. However it works for you is fine by me. There's no there's no right or wrong. What I mean to stick to your portfolio is, let's say you have a big chunk of your assets and they are in your 401k, for example, and that's really long-term money, and you're dollar cost averaging every month because you're putting money in every pay period or every other pay period into your 401k plan or some other retirement plan. If you decided, hey, I'm going to go to all cash in that account, and with the thought process that you'll get back in later at a lower price, that usually doesn't happen. I'm going to say it never happens. Not to any one of you. Okay. Don't mean to insult you, but then what happens is the market goes lower. You think, oh, I'll wait. It's going lower. The market goes up and you think, well, I could have had it when it's lower. Now it's up. So now I'll wait. And it just becomes endless procrastination and you just wind up hurting yourself. The idea is not timing the market. It's time in the market. It's keeping your funds invested appropriately for you based on your risk tolerance, your time horizon, and your goals. So the longer term you have until you need your money, the more aggressive you could be. Aggressive doesn't mean speculating. Aggressive doesn't mean betting all your money on airline stocks or penny stocks or pot stocks or Bitcoin. That's speculation. What I'm saying is I included airlines in that speculation. I mean, if you have an airline stock where it's part of a portfolio, that's a different story. But if you're just betting all your money on that is, to me, speculating in a industry that may or may not live to see another day. So if you are speculating with a portion of your money, that's one thing. But if you have an investment plan that's part of your financial plan to get you from point A to point Z, to get your kids through college, to get you through retirement, or other goals you may have, a vacation home, a second home, a boat, whatever. The idea is you put together a portfolio of assets. Typically, we're talking about stocks and bonds, or the products that package those, like exchange traded funds and mutual funds. So that's what I mean by a packaged product. And you put together these products in a way that is supposed to be good for you, whereas you have a certain amount in stocks, bonds, and cash. And then out of the stocks, you can divide it between international, growth, value, large cap, small cap, mid cap, etc. The idea is to get it to a point where you will not be frightened out of the market. A lot of people made changes to their portfolio because they were worried. They were making emotional decisions, and now they're wondering if they should get back in or not. There was a massive amount of cash that went to the sidelines, or a massive amount of people who cashed out and decided to wait for a better time. And that's what I mean in this. So I like to ask, what good is an investment account, an investment plan, or a strategy if you can't stick with it? And that's the issue. So some of the things you could do is make sure you rebalance your portfolio. Whereas if you had a certain amount of your portfolio designated to stocks, let's say 70% of your portfolio into stocks, and now that's maybe 80%, and your overall portfolio has gone up, maybe shave that 80% back down to 70%, and maybe bonds were 30%, and now they're 20%, bring those up to 30%. So you rebalance. And you have to also think, now that we've gotten this recovery after such a blowout, crazy market retreat, do you have too much money in stocks? Or did you have too much money in stocks before this? Because if you couldn't wait, if you couldn't handle the pressure, then you need to reevaluate your risk tolerance and have less money in stocks. And you'll just have to accept that when stocks go up, you'll make less money. The idea is, let's say that you might make less than the market when the market goes up, but you'll lose less when the market goes down. If you were Rip Van Winkle, you had 100 years to just leave your portfolio alone. You're going to go to sleep for 100 years. This doesn't matter because there's no question we expect stocks and all other assets to be higher in 100 years. So the issue is we have time horizons until we need our money, until our financial obligations come up. So based on that, have you made any sudden moves that you now regret? It's okay if you made a bad move and you regret it. The idea is to learn from it and move on. You know, the most important thing to know as an investor is to know yourself. That's the hardest thing to know. And if you, or maybe turns out you weren't as brave as you thought, or maybe you are braver than you thought, then you could make those changes accordingly in your portfolio. Another thing I do for my clients is I have their assets separated. We'll have a conservative account, a mid-tier, mid-range, mid-risk account, and a risky account. And the risky account could be all stocks, for example, but that is a portion of money set aside for a client who won't be touching that money for 10, 20, 30 years or even longer. And the conservative portion of an account, of the overall pie, a separate account, is if the market goes up or down, that's okay. You have that portion of your assets if you need them. And it's okay if the rest of the market goes down because you expected your other accounts to go down and you are confident that they'll recover one day, but you've got the conservative part of your account, of your portfolio, holding up just fine. And then you've got a mid-tier portfolio, which is maybe, let's say, a 60, 40, or 50% split between stocks and bonds. And that'll have ups and downs, but they'll be moderated because of the diversification aspect between more stable investments and risk investments. Diversification, it's not a strategy for higher returns. It's a strategy we use to mitigate risk in case we're completely wrong in one part of your portfolio. The other parts of your portfolio will be okay. All right. So, and then the other thing you have to take a look at is, do you have enough diversification? I find most people don't. I find that a lot of people miss out on what diversification is supposed to do for them. A lot of people believe that diversification means they have a lot of holdings in their investment account. They have a lot of holdings, they have a lot of different stocks or a lot of different exchange traded funds or mutual funds. But then when I take a look at the portfolio, I find, yes, you have, let's say, 25 stocks, but there's Microsoft, there's Amazon, there's Facebook, there's Nvidia, and it's just, 20 out of the 25 stocks are either tech or tech related, with maybe, 2 drug stocks, an energy stock, and a bank. That does not mean diversification because you've got 20 stocks coming from the same area. There are 11 sectors of the economy. I'm not saying you need to have exposure to all 11 sectors of the economy, but at least 5 or 6, in my opinion. You want industrials, you do want tech and communications, you want some energy, some financials, some consumer staples, maybe some consumer discretionary, and that starts to give you a diversified portfolio. This was a very big topic in the year 2000 when we had the tech wreck. A lot of people had a lot of mutual funds, but what they didn't realize is all of these mutual funds, which had words in like, innovations or growth in the name of the funds, there were basically all of these funds were in the same tech stocks, and these funds were overindulging in the tech sector. So when the tech space got crushed, people's investment accounts got crushed along with the market. And the problem was because they didn't really have as much diversification as they expected. So this is why it's important to have, let's say, small cap, mid cap, and large cap stocks, because you will get diversification. It's very hard to have overlap when you have a small cap exchange traded fund and a large cap exchange traded fund, because the small cap exchange traded fund won't have Amazon and Facebook and Microsoft, et cetera. It'll have stocks you probably never even heard of. That's how you get the diversification. And that's what enables you to stick with a portfolio through thick and thin. Because again, what good is an investment portfolio if you can't stick with it? I'd like to thank you for watching. I don't see any comments out there, but I do see a couple of reactions out there. Hey, Frank, great to see you. Judy, good to see you. A couple people are watching in the various social media outlets that I'm streaming to. But I'm going to get going. It's about 20 minutes. I think that's more than enough. I hope this helps you out with your understanding of investing. And I'll see you tomorrow. I can't believe tomorrow's Thursday already. Have a very, very happy, good night.